Welcome to Chapter 6, Portfolio Management of Stock Funds. Stock picking gets the headlines, but portfolio construction has to pay the bills. A manager begins with information, turns that information into a testable thesis, connects the thesis to valuation, and then decides whether the idea deserves a position at all. After that come the less glamorous questions: how large, how liquid, how correlated, how expensive to trade, and what evidence would force a sale. This chapter treats stock fund management as a chain of decisions rather than a contest to name attractive companies. A good stock idea is not yet a portfolio. It is a job candidate with an impressive resume. The manager still has to check the references, understand the risks, decide the role, and monitor performance after the hire. By the end, we will have a practical framework for research, valuation, position sizing, risk budgeting, capacity, and the difficult search for persistent alpha. A great company and a great investment are not the same thing. The market does not grade a business against average quality. It grades the result against expectations already embedded in the price. History is full of admired companies bought at heroic valuations. From the Nifty 50 era to the dot-com boom, many businesses kept growing. Their stocks still disappointed because the price had assumed even more. That is why the active manager needs a variant view, not simply a list of companies everyone already respects. The slide also shows the empirical hurdle. 79% of active U.S. large cap funds underperformed the S&P 500 in 2025. Research, therefore, has to survive valuation, portfolio construction, implementation, fees, and taxes before it reaches the shareholder. The market grades on expectations, not effort. Ferraris are excellent cars, but price still matters, especially when the seller has already included 10 years of perfect driving in the sticker. This chapter develops 4 connected skills. First, research. You should be able to separate information gathering from a differentiated, testable investment thesis. Reading a filing is useful, but it becomes investment research only when it changes a forecast, a risk estimate, or a decision. Second, value. You should connect growth, margins, reinvestment, capital intensity, and risk to a reasonable range of outcomes rather than one magical target price. Third, construct. You should translate conviction into position size while accounting for downside, liquidity, correlation, concentration, and factor exposure. Finally, evaluate. You should be able to separate security selection skill from a favorable market regime, a factor tailwind, low trading cost, or plain luck. Notice the sequence. Research without valuation can become admiration. Valuation without portfolio construction becomes a spreadsheet exercise. And a result without attribution can become a victory speech delivered before anyone checks where the return actually came from. 4 questions organize the module. First, how does information become a thesis? We will examine idea generation, primary evidence, channel checks, alternative data, consensus expectations, catalysts, and disconfirming evidence aren't. Second, how does a thesis become a value range? That requires understanding the business, forecasting cash flows, testing scenarios, and deciding which assumptions matter most. Third, how does value become a portfolio position? Expected return is only one input. Position size must also reflect uncertainty, correlation, liquidity, factor load, and portfolio limits. Fourth, how does the result become learning? Attribution, sell discipline, team process, capacity, and an auditable research record help distinguish good luck from a repeatable edge. The order matters. Starting with the stock price and inventing a thesis afterward is not research. It is storytelling with a Bloomberg terminal. We want a process that can be explained before the outcome and evaluated after it. A repeatable research cycle has 6 stages. Source the idea through screens, industry work, company meetings, suppliers, customers, or alternative data. Understand the business model, competitive position, incentives, and industry structure. Forecast the variables that drive value, revenue, margins, reinvestment, free cash flow, and balance sheet risk. Value the business under base, upside, and downside cases. Then challenge the work. Seek disconfirming evidence and ask what the market may understand better than you do. Finally, decide. Set the position size, catalyst, review triggers, and sell discipline before enthusiasm takes over. The challenge step is often the least popular because analysts, like everyone else, enjoy being right. Unfortunately, the thesis has no obligation to return the affection. A good research record lets the team distinguish a bad outcome from a bad process. Sometimes a sound decision loses money. Sometimes a weak process gets lucky. The record is how the organization learns the difference. Information is not an edge merely because it is new, expensive, or displayed on a beautiful dashboard. Primary evidence includes filings, earnings calls, contracts, regulatory records, product data, and observed economics. Channel checks with customers, suppliers, competitors, and distributors can test whether the company story matches the operating reality. Alternative data may add timeliness through transactions, web traffic, pricing, or geolocation, but it also creates licensing, privacy, quality, and governance questions. The real hurdle is consensus. An accurate forecast that matches what the market already expects may have little investment value. The thesis should state exactly which assumption differs, and why the price may eventually adjust. Just as important, define disconfirming evidence before the position grows. Counting cars in a parking lot can be interesting. It becomes useful only if vehicle traffic is connected to a decision-relevant variable and collected legally. The best research question is often simple. What would have to be true for today's market price to be correct? Equity value is ultimately tied to cash that can reach owners. Multiples are useful, but they are compressed valuation models. A high price to earnings ratio quietly assumes something about growth, margins, reinvestment, durability, and risk. Growth matters only when the company can convert it into attractive economics. Margins reveal pricing power, competition, and operating leverage. Reinvestment tells us how much capital the business must consume to support expansion and what return that capital earns. Risk and duration determine how heavily distant cash flows are discounted. The growth stock repricing of 2022 made that last point painfully visible. When rates rise, a business whose value depends heavily on profits far in the future can be especially sensitive. A discounted cash flow model is not a magic incantation. A model with 20 tabs is still an opinion with decimals. The purpose is to expose assumptions, compare scenarios, and identify which variable can change the decision. Scenario analysis is more honest than presenting one target price with 2 decimal places. The base case should reflect the most defensible operating path, not the analyst's favorite outcome. The upside case should explain what goes right, how quickly it happens, and whether the return comes from better fundamentals, a higher valuation, multiple, or both. The downside case should identify real failure mechanisms, demand weakness, margin pressure, funding stress, competition, regulation, or execution. Assigning probabilities forces optimism into the open and supports a probability-weighted value. Path dependence also matters. A company may eventually reach the expected endpoint but suffer dilution, covenant pressure, or customer losses along the way. Finally, identify a catalyst or recognition mechanism. A thesis can be economically correct and still be a poor investment if the market has no reason to revise expectations within the portfolio's horizon. Precision is not the same as accuracy. Sometimes the most honest answer is a wide range with clearly stated reasons. Portfolio construction is where individual opinions begin interacting. Start with expected return, including upside, downside, and probability. Then assess thesis risk, uncertainty, balance sheet strength, cyclicality, and event exposure. Correlation asks whether the idea adds a new return engine or simply repeats risks already in the portfolio. Liquidity asks how many days it could take to exit under normal and stressed volume. Factor analysis measures exposure to size, value, quality, momentum, sector, country, and currency. Only then should the manager set the initial weight, maximum weight, review triggers, and rebalancing rules. A portfolio can own 30 different stocks and still be one large bet if every holding responds to the same interest rate move or investor crowd. That lesson became obvious when many expensive growth stocks declined together during the 2022 rate reset. Diversification is not a head count. A portfolio is a system of interacting risks, and position size is the point where conviction meets humility. Active share and tracking error answer different questions. Active share measures how different the portfolio weights are from the benchmark. Tracking error measures how variable the portfolio's return has been relative to that benchmark. A closet index tends to have low active share and low tracking error. A diversified stock picker can have high active share but only moderate tracking error if many company-specific bets offset one another. A factor timer can have more modest active share, yet high tracking error because one systematic exposure dominates the return. A concentrated active portfolio may score high on both measures. Neither statistic proves skill. High active share means the manager is different, not correct. High tracking error means the investor should expect a bumpier benchmark relative experience, not necessarily a better one. The useful question is whether the pattern matches the strategy being sold and the fee being charged. The market does not award bonus points for originality. It only pays when the active differences are well chosen and well implemented. Risk budgeting asks which losses the manager is willing to own and which losses would be accidental. Position limits prevent one thesis from becoming a franchise-threatening event. Sector and factor limits control unintended systematic bets while preserving room for deliberate views. A liquidity budget asks whether the portfolio can meet redemptions without turning a normal exit into a fire sale. The drawdown process should define who reviews the thesis, what evidence matters, and when risk must be reduced. Scenario tests estimate the effect of shocks to growth, rates, commodities, currencies, and correlations. Derivatives and counterparties add leverage, collateral, and nonlinear exposure that may not appear in the physical holdings list. Good risk limits protect the strategy rather than force every portfolio to resemble the benchmark. A risk budget is a seatbelt. It does not choose the destination and it cannot prevent every accident. But it is most valuable when confidence is highest and the road looks deceptively easy. Turnover can add value when new information changes expected return. A risk rises materially, a catalyst resolves, a better opportunity exceeds the switching cost, or tax losses create an advantage. Turnover destroys value when the manager reacts to price noise, churns around tiny ranking differences, trades beyond the market's capacity, or allows short-term incentives to reward activity instead of outcomes. Every trade carries spreads, market impact, delay, taxes, and the possibility that the original position was sold just before the thesis worked. A busy portfolio can look productive while quietly donating alpha to brokers, counterparties, and the tax authorities. The right comparison is not new idea versus old idea in a spreadsheet. It is the expected improvement after the full cost of switching. Activity is easy to count. value is harder. Trading should be a capital allocation decision, not proof that the portfolio manager came to work that morning. Fundamental and quantitative investing increasingly overlap. Fundamental teams bring deep business context, explicit company forecasts, and qualitative judgment about management, competition, and industry structure. Quantitative teams process broad data sets, test repeatable signals, optimize portfolios, and monitor risk across large universes. Both approaches contain model risk. In a fundamental process, the model may live inside analyst judgment and assumptions. In a quantitative process, it may live in data quality, specification, crowding, or regime change. A computer can be wrong with impressive consistency, while a human can be wrong with impressive confidence. Hybrid teams try to combine domain expertise, data engineering, statistical discipline, and accountable judgment. The meaningful question is not whether the process is human or machine. It is how evidence becomes a decision, how the decision is constrained, and how the team detects when the approach stops working. A spreadsheet and an algorithm can both create false precision. Only one usually does it to 12 decimal places. The active large cap base rate is difficult. According to the S&P Active versus Index scorecard, 79% of active U.S. large cap funds underperformed the S&P 500 in 2025. Over the 15-year period through 2025, the underperformance rate was 89.93%. These figures are net of fees, which is the experience shareholders actually receive. The data do not prove that no manager can add value. They do tell us that manager selection begins with a demanding prior probability. Investors need evidence of a repeatable process, appropriate capacity, stable resources, sensible fees, and results that are not simply a disguised factor bet. Survivorship and market regime also matter when interpreting any performance study, but the burden of proof belongs with the active strategy. The bar is not impossible. It is simply not friendly. Asking whether anyone can win is less useful than asking what evidence would identify skill before the result is known. AI and alternative data can expand research capability, but they also expand the model risk perimeter. Data lineage means knowing the source, license, consent, revisions, survivorship, and representativeness of each data set. Validation requires separating training, testing, and live monitoring while checking for leakage and overfitting. Human oversight should define who may override a signal, why, and how exceptions are reviewed. Alternative data also raise privacy, contract, and material non-public information concerns. Vendors create cyber, continuity, and dependency risks. Finally, marketing claims must match actual practice. The SEC has brought enforcement actions involving exaggerated AI claims, a useful reminder that adding the letters AI to a presentation does not create an investment process. Technology can make a strong process faster and broader. It can also make a weak process fail at scale. The fiduciary standard does not change because the model has a better user interface. Consider the case of a wonderful business purchased at an impossible expectation. The company had grown revenue at 35%, and the fund bought after several years of exceptional execution. Growth remained strong, but it slowed to 18%. The business was still healthy. The stock fell because the valuation had assumed extraordinary growth would persist longer. This is the difference between being right about the company and right about the security. Long duration growth stocks are especially sensitive when rates rise or expectations reset, as investors saw across the market in 2022. Position size should reflect that asymmetry before the disappointment, not after it. Sell discipline also matters. A lower price is not automatically a bargain if the expected return range has deteriorated or the original assumptions were too optimistic. One of the market's favorite practical jokes, is allowing the company to hit its targets while the stock falls. The thesis must include the expectations embedded in price. A strong investment memo makes the thesis, risk, and portfolio action auditable. Start with the variant view. What does the market appear to believe, and where is the research different? Next, present a value range with base, upside, downside, and probability weighted outcomes. Identify the catalyst and horizon. What could change expectations? And how long can the thesis reasonably take? State the key risks and the facts that would break the idea. Explain the position logic, including conviction, downside, liquidity, correlation, factor exposure, and portfolio limits. Finally, define review and exit rules. Which facts require adding, reducing, or selling, and who has authority to decide. The memo is not a prediction trophy. It is a control document. Memory is a poor risk system, especially after the price moves and everyone develops a surprisingly accurate recollection of what they meant. A clear memo disciplines the original decision and makes later learning possible. Now apply the framework. The manager has 3 stocks with similar expected returns. Stock A is highly liquid, but correlated with several current holdings. Stock B adds diversification, but trades thinly. Stock C has the strongest upside and a binary regulatory decision in 6 months. The fund is already near its sector limit and has recently experienced redemptions. There is no responsible answer that begins and ends with, I like stock C the most. For stock A, measure the incremental portfolio risk rather than the standalone story. For stock B, estimate stress days to trade and set a maximum weight the fund could exit without punishing remaining shareholders. For stock C, treat the regulatory event as a scenario with an explicit loss estimate and monitoring plan. Then propose weights that respect the sector limit and liquidity needs. Pause the video now, write down your 3 weights, the main reason for each, and one additional fact you would request before committing capital. Defend the portfolio, not just the opinions. Pause and answer 4 questions. First, what is a variant perception? Second, why is position size not determined by conviction alone? Third, what does high active share indicate? Fourth, what is the strongest purpose of disconfirming evidence? Pause the video now and choose an answer for each before continuing. When you resume, compare your reasoning. A variant perception is a specific expectation that differs from what the current market price appears to reflect. Position size also depends on downside, liquidity, correlation, factor exposure, and portfolio constraints. High active share means the holdings and weights differ materially from the benchmark. It does not guarantee high return or low factor risk. Disconfirming evidence is sought in advance to challenge the thesis before losses force the review. The common thread is discipline. Active management is not rewarded for confidence alone. It is rewarded only when differentiated judgment survives valuation, risk control, implementation, and the arrival of new facts. Carry 6 claims forward. First, price matters. A good business becomes a good investment only when expectations and valuation leave room for an attractive return. Second, the thesis must differ. Research adds value only when it changes a forecast, a risk assessment, or a portfolio action. Third, portfolios interact. Correlation factors, concentration, and liquidity connect ideas that may look independent in separate research reports. Fourth, size is a risk decision. Conviction must be tempered by downside, uncertainty, liquidity, and event exposure. Fifth, implementation can erase alpha through turnover, market impact, taxes, and capacity. Sixth, the process must be auditable. Memos, review triggers, attribution, and sell discipline allow the team to learn from outcomes. Conviction is valuable. It is not a position sizing formula. In Chapter 7, we adapt this decision system to bond funds, where yield, duration, credit, optionality, and liquidity create a different set of portfolio interactions. This final slide is the refresh register for Chapter 6. Posen and Hamaker provide the chapter's operating architecture. The S&P Active versus Index Scorecard supplies the current active management base rates. SEC materials support the discussion of Form N-Port, advisor marketing, and AI-related enforcement. CFA Institute resources provide additional valuation context, while Investment Company Institute research supplies industry and active versus index data. There is no reason to narrate every web address. The important habit is to distinguish primary sources from commentary and to check the publication date before reusing a statistic, rule, or market practice. Sources are not decoration at the end of a deck. They are part of the investment process because they reveal what is evidence, what is interpretation, and what may have changed. The next module is Chapter 7, Portfolio Management of Bond Funds, where the same discipline meets a different return system. Income, duration, curves, credit, optionality, and liquidity.